In this video, we're going to look at Bill Ackman's analysis of Starbucks, and in doing so, we'll try and find some broader concepts around valuation and business analysis that can be used. We will cover, does the company have a moat, a competitive advantage that sets it apart? Then we'll go on to what the company is doing to keep expenses under control, and then what is driving growth in the company. After that, are the company management shareholder orientated? And then finally, is the company cheap relative to its intrinsic value? If so, why? But first, who is Bill Ackman? Bill Ackman founded and runs Pershing Square Capital Management. Ackman created Pershing Square in 2004 and rose to fame for his short of bond insurer MBIA and his rescue of mall operator General Growth. In 2020, he made $2.6 billion off a bet that coronavirus would crash the stock market. From 2005 to 2019, he made a cumulative return of 492%, compared to the S&P's 166%. Ackman introduces Starbucks in his 2018 annual report as follows. The global dominant brand in the specialty coffee category with 30,000 owned and licensed stores that generate approximately $35 billion in annual system-wide sales. That's pretty impressive, and he's making reference to it's a powerful brand which is akin to something like Coca-Cola. We've all heard of Starbucks, right? Even in countries where there aren't many of them, that should reinforce how powerful this brand is. Starbucks has a loyal customer base, many of who will turn up daily to purchase food or beverage. So Starbucks' moat is its brand. Bill mentions there's a high rate of return for free cash flow and reinvestment. This is great because it means they're using a lot of what's left to reinvest in the business. But what's important here is the money is being used effectively. A business that doesn't have a high rate of return for the free cash flow is better off either returning the money to the shareholders in the form of a dividend, paying down debt, or if the stock price is below the intrinsic value of the company, buying the shares outstanding. Ackman mentions the business simplifying as another positive. Here I think he could be referring to some of the following. 1. The sale of Tazo, a tea company, to focus on Teavana. 2. The closing down of Teavana stores due to the rising sales of Teavana in Starbucks stores and supermarkets starting to stock the product as well. 3. They also closed their own online store to focus selling on superior e-commerce platforms. When you've done your research on a company and the business has met certain criteria, you're going to want to think about valuing the business. And that will involve forecasting growth. And I think when people first start out, they think it's easy. I'll just use the past years as an estimate for future growth. And I definitely did that myself. But the main issue there is that past growth is not necessarily indicative of future growth. You could include this in a multiple scenario analysis of growth, which would involve assigning probabilities to different outcomes and then taking the average. But there's definitely questions you can ask to get you more of an idea, such as where will the business growth be coming from? How fast are the new stores growing? Are the older stores growing? With that in mind, Bill comments, new Starbucks stores have industry-leading unit economics, which we estimate generate a pre-tax return on investment of 55% in the US and 75% in China. The company should continue to grow revenues at a high single-digit rate, driven by unit growth in under-penetrated markets such as China, where per capita coffee consumption is less than the 1% of US levels, and product innovations which have generated continued same-store sales growth. First thing, those returns sound impressive, and they are, but they should be viewed in the context of the proportion of the business that they represent. It becomes obvious when looking through the annual reports and investor presentations that Starbucks have high hopes for their expansion into China. It's also worth noting that Starbucks have partnered up with Alibaba and using various mobile app services such as Almi, think Uber Eats, Tmall and Alipay to market and distribute Starbucks products. They've even opened up a virtual Starbucks store. Management have identified two major drivers for growth, the US and China. Starbucks have already been in China for 20 years as of 2017, but at this point in time they were looking to expand and ramp up their presence in the country. The 2017 annual letters to shareholders go so far as to state they were building a new Starbucks every 15 hours. Just as a side note, one of the risks foreseen by management in the 10K was the US-China relations. Management did identify they were dependent on China for a portion of their growth. With everything that's happened in the past 2 years, this has been an issue that's been exacerbated. That said though, that hasn't stopped Starbucks rollout in China so far, Ackman details how their closest competitor in the region, Luckin Coffee, has closed shop and Starbucks is planning on opening up a further 600 stores in the region by 2021. In 2016, Starbucks rolled out the product, the Nitro Cold Brew, in select locations and had incremental upward sales, so much so that it's now being rolled out nationally. It looks like Guinness, it's even poured like Guinness, but it's coffee. Its uniqueness may have the potential to draw in new customers, and Bill thinks it could have a positive impact on growth. Bill also refers to the update to the customer loyalty card program. This was in 2016. Customers earn 2 stars for every dollar spent. Upon gaining enough stars, customers can redeem this for coffee, beverages or food in the future from stars. This has the effect of rewarding existing customers and their loyalty and potentially ensuring new ones stay. Longer term, Starbucks expects consolidated revenue growth of 7 to 9%. So after looking into all the areas for potential growth, Ackman states the growth targets set by Starbucks seem conservative, which is a positive. So not only did Bill Ackman recognise that Starbucks was cheap, so did Starbucks management, because as Bill points out, there was the 20 billion share buyback program. What this does is it gives shareholders a bigger piece of the pie. If there's less shares and the earnings still remain the same, it has the effect of making the earnings per share go up. Doing so when the stock price is cheap relative to the intrinsic value is ideal for shareholders and shows the management is shareholder orientated and knows what they're doing. There is also a dividend, and despite its growth, Bill predicts the business will still grow. So Bill points out that Pershing Square managed to acquire the stock 25% cheaper than the historical price to earnings, despite earnings growing 50% during the 3 years prior to purchase. I've noticed reading Michael Burry, Nick Sleep, and now Bill Ackman, that when they believe a stock to be cheap, they look for a reason as to why. At this point, you would check the news in relation to any headlines for the stock to see if there's anything you've missed, and whether it could impact the prospects for a stock or if it's an overreaction by the markets. With that in mind, Bill states what he believed the market price dropped. We believe that the reduced valuation was driven by concerns regarding a slowdown in US same-store sales, the perceived risks to achieving its long-term financial growth targets, and uncertainty due to the company's senior leadership transition and management turnover. After the point of purchase, same-store sales went up by 1 to 2%, and then a further 4% for 2 quarters. So Ackman has a lot of positive things to say about Starbucks, but he sold it just before coronavirus kicked off in America because it had reached his intrinsic estimation of its price, before then repurchasing it again in the coronavirus dip and then selling it again not too far down the line. The second time he sold it was because of expected returns that were below expected long-term targets. This approach is slightly different from the Warren Buffett hold approach and is more in line with his mentor, Benjamin Graham, who held stocks until they roughly reached their estimated intrinsic value. So we've covered the following in this video. Does the company have some sort of moat? In this case, a strong brand that people recognise and a large body of people are loyal to. Does the company reinvest its cash flow at a good rate of return? What's driving growth? Are managers shareholder orientated? Is the company cheap relative to the intrinsic value? If so, why? We'll delve deeper into some of these topics in the future, but if you like the video, consider leaving a thumbs up or subscribing. Or even if you didn't like it. Have a good one.